Good evening, everybody. All right, we're going to kind of do a little bit of scripted information here tonight. Through the past year and a half, I've kind of gotten away from the fact that enough new people coming in that still have not yet seen kind of the basics of candlesticks. So that's why we did kind of a basics training last Saturday. And so there's three key elements to candlestick analysis. Number one, obviously, is the candlestick signals themselves, and that's why we kind of did the basics. So you got the candlesticks and the patterns, and then you've got support and resistance levels, and the most common are the moving averages. And then to get real uh, powerful moves is candlestick signals and gaps. So tonight we're going to kind of concentrate on the high probability situation set up by the moving averages. So we're going to go through kind of a PowerPoint session kind of explaining why they work effectively or why candlesticks and moving averages work effectively together. And then we'll go to the live charts to show the results of that information. So yes, this is being recorded. So here we go. Moving averages. And that's basically, we can use moving averages to put ourselves in a situation where we're positioning our portfolio in the direction of the trend, and or if we know which way things are moving based upon analysis of the market in general or the trading entity that we're working with, we can be more on the right side day trading or swing trading just by knowing which direction that the general market or the general price move is heading. So obviously, if we're day trading Apple and it's on the downside, we'll probably want to be trading it more oriented to the downside. So the basics of trend analysis, whether it's stock price or uh, individual or the market indexes, is very simple. Our basic number one criteria is the signals, the patterns, where we are with stochastics, and where are we with support and resistance level, like trend lines and moving averages. Now, on my charts, as you've seen quite often, the moving averages we have on our charts are the 200, the 50, and the 20 simple moving averages. And the reason for that is that everybody in the world uses those to make their decisions about their portfolios. Then we're going to also go into the T-line, the 8 exponential moving average. So very simple common sense is, or chart analysis. Which direction is everything moving? The 200 is the red, the blue is the 50, the gray is the 20, and then the T-line, which is the most effective trend analytical tool that I've come across in the last 40 years, is this black line. So very simple rule of the T-line. You see a candlestick buy signal and a close above the T-line, you can stay long until you see a candlestick sell signal and a close below the T-line. And we also can get better assessment of our trend based upon the nature of each candlestick signal. As we can see here, this pullback consisted of a bunch of indecisive trading days, dojis, hammers, things that didn't show very decisive selling. Got back to the T-line and bam, they took it right back up again. So that kind of gives you a visual indication of what is the force on the long side or the short side, whether there's been a reversal or not. But the most important factor of the moving averages is you can see where and when they're using it for support or resistance. In this case, the 50-day moving average, you can see was a constant influence as far as the support, and you look close enough, you can see every time it came back to the 50-day moving average, there was candlestick buy signals that were being confirmed. So it makes trend analysis very simple. As long as your trend and your support levels are maintained, you can stay in that direction. Once it's breached, it tells you there's been a change of investor sentiment. Again, this is not rocket science. This is just common sense. And moving averages have truisms. If a moving average support is breached, it will then be tested to see if it's going to act as resistance. So you break down through a support level, what's the first thing they do? They come back up and test it and see if it's going to be acting as a resistance level. And then the next scenario is, if a support or a resistance level is breached, we usually come back and test it, see if it's going to act as support. Once again, the advantage we have is we can see what type of investor sentiment is occurring at a resistance level or at a support level. Same scenario when we are analyzing a trend. Use the 50 as went through, use it as support. Where's the next target? The 200-day moving average. What type of signal do we see up here? Shooting star. Where do you think our next move is? Back down toward the 50. Next time they come up through the 200, candlestick signal tells us they aren't resisting, and they come back and act as support. That tells us our uptrend's still going to remain in progress. So if we know the nature of a support and resistance level, there's some very simple price movements based upon moving averages. What we call the blue ice failure, where they've fallen through the ice, the support level, they come back up, test it, fail, and my late friend Dave Elliott of Wall Street Teachers would describe it as somebody falling through the ice. They come up trying to find the hole they fell through. They can't find it. They drown. Where they go? The bottom of the pond, which is the next support level. At that point, especially with stochastics in the oversold area, we can see exactly what the investor sentiment is at those levels. Buy signal, Morningstar signal was our next target, likely the 50-day moving average. So the reason that we can see these patterns or these support levels is because of support and resistance. There's our big fry pan bottom. Where does the fry pan bottom usually break out? Right about where the pattern starts. In this case, there was a double confirmation. Not only did it break out right at where the pattern started, but it broke through the 200-day moving average. Where is it more likely to break out? Right here at the beginning of that pattern. That tells us the fry pan bottom's breaking out, much more upside. If we're analyzing market trends, we can see what type of signals occur at a resistance level and at a support level. If they break, or if this had continued up, obviously we would have a different pattern. But the fact that we could see that right at this moving average, the 50-day moving average, we were starting to see sell signals, that told us they weren't going through. We'd get ready to be ready, or get ready to go the other way. Kicker type star signal pretty much tells us that this 50-day moving average is acting as resistance. If we can see what a trend is doing, and then there's a reversal breaking this trend, and they come up to the first major resistance level, what do we want to see at that resistance level? We want to see they got through. However, we can see on that day there was a shooting star signal in the overbought condition right at a resistance level. And what do we know about our shooting star signal? If they open it lower the next day, you close out your position. And in this case, we can get ready to go short because what was our analysis of this trend in the first place? We're in a downtrend. They moved it up, failed. They're still moving it down. So the whole crux of this presentation is at major support and resistance levels, we've got the benefit of seeing what type of signals are occurring there, so we know exactly what's happening as far as a reversal or a continuation of a trend. So also, moving averages act as magnets. There's a very simple reason for that. If you're a major money manager and you like this stock, you finally get it through your committees that you can go ahead and buy this, but you see it's drifting back, where do you think you're going to start buying? You're probably going to wait to see if it comes back to the 50-day moving average to see if it's going to act as support. So why does it come back there? Because everybody that's ready to buy it is waiting to see if it's going to come back and support there. So there's really not a whole lot of buying. So the sellers are pretty much in control. Again, the advantage we have is we can see exactly what's happened at these support levels. In this case, a morning star signal. That told us immediately. And I always go back to somebody asking me a while back saying, how many days does it take for you to confirm that your trend has reversed? And the answer is 0. If we see there's a reversal signal, especially on a major support level, and it confirms the next day, we're buying, because that's the whole point of recognizing what the signals are telling you, that there was a potential reversal signal. Now we're getting ready to see if it confirms. So that's why the major moving averages act like magnets, because everybody's making their decisions at that level. And we can see immediately what those decisions are. If we hit resistance levels, evening star signal right at the 200, stochastics rolling over. Remember, if you took out everything else out on this chart, other than your price and your stochastics, you've got the very simple conclusion that the Japanese rice traders have illustrated for us, that if you see a candlestick sell signal in the overbought condition, likelihood you're in a downtrend. Well, now if you start adding other elements like resistance levels, moving averages, the T-line, you get that much more clarity as far as what's happening in investor sentiment. They're selling it off, they pop it back up, and where did they pop it back up to? Right smack dab to the 50. What do you think everybody was watching here at the 50? See whether it was going to get through. If not, they start selling it again, continuing that downtrend. Now, the most important of our moving averages is the T-line, the 8 exponential moving average. And this has a completely different perspective as far as support and resistance. Very simple. If you see a candlestick buy signal and a close above the T-line, you can stay long until you see that candlestick sell signal and a close below the T-line. Now, why does that work so effectively? Well, remember, the other moving averages act like magnets. So everybody's watching to see what's happening there. Nobody has the T-line on their charts. So what it basically has is kind of a Fibonacci characteristic that acts as a natural support and resistance to human nature. So if you combine the fact that the candlestick signals are the graphic depiction of what's going on in investor sentiment, and you combine that with the natural support and resistance level of the T-line, that combination becomes extremely powerful as far as keeping you in the right trade at the right time. And there's plenty of times where it looked like there might be a reversal, but we didn't have the confirmation, number one, of the signal, number two, of a failure of the T-line. So anytime you start seeing that breach of that uptrend, now we start looking to see what's going to act as support on the downside. Again, here's that blue ice failure. We fail here, head on down. They take it back up. We can see exactly what the nature of investor sentiment is once it come back up and hit that level again. There's our doji. There's our doji in the overbought condition. And what's our simple rule of the doji? They're going to move it in the direction of how they open it the next day. So if they open it lower the next day, what's that tell us about the 50? Told us they failed. You want to start going short again, or at least be out of that position. And where are they going to head to? By the next obvious support level, which would be the bottoms down here. And when it got here, instead of doing dojis, and we could see that it was in the oversold area, what's that give us the kind of the foresight to do? Be ready to cover our short positions on these signs of buying at this level. So there's T-line truisms. But if you see a candlestick buy signal, this one right here looked like a buy signal, but what didn't it do? Didn't close above the T-line. This one was different. There's your morning star signal and a close above the T-line. That tells you there's a different dynamic in investor sentiment. That's when you can start buying. Another candlestick or T-line truism is that the further away you move from the T-line, the higher the probability it's going to come back and test it. So we're going to be doing a session Tuesday on entry and exit strategies using candlestick signals. And again, that's the nice thing about candlestick analysis is if the Japanese rice traders have illustrated when the bulls are taking control based upon the signals, there's also very simple stop-loss procedures. And one, for example, would be if this was a bullish engulfing signal and it opened positive the next day, Japanese rice traders have a very simple rule. The bulls should be in control. If they close it more than halfway down that candle that told you the bulls were in control, the bears are still in control. You close out the position. That's that process of cut your losses short and let your profits run. On the other hand, what's our simple rule of the T-line? The further away you move from the T-line, the higher the probability it's going to come back and test it. Well, if you've been holding this, now all of a sudden you've got huge profits up here. Very simple strategy. You flip to your 10-minute chart, and because you already know you're extremely way far away from the T-line, that if this starts trading through or coming back down with a sell signal through the 10-minute T-line on the 10-minute chart, it means that's where the profit taking started. You take your profits up here instead of waiting to give it back all the way back to the T-line. Again, just like any other moving average, the further away you move from the 50, the more likely it's going to come back and test it. On a quicker basis, the further away you move from the T-line, the more likely you're going to come back and test it. So that makes that when do you start selling? You start moving too far away from the T-line and you see some candlestick reversal signal potential, you start taking some profits at that point. Let's see, where have I gone? Also, the T-line, as far as one of the moving averages, tells us when a trend is reversed. In this case, if you took your profits here and it came back to the T-line, notice the nature of what it was doing right here on the T-line, very indecisive. What was it telling us? It was pretty much telling us they weren't going to close this below the T-line. That tells us we've got a J-hook pattern, so we can be buying again. So I have no qualms about closing out right here and buying back here. It used to be before candlesticks came along, and I took profits, and then you turn around and took it back up. First thing I'd say, they're not going to trick me to get back in and then pull it right back again and take some more of my profits. At least now I know what the nature of human nature is, what type of patterns are the most effective. J-hook pattern is one of them. If we see a major reversal signal, here's our morning star signal, but it's not at a end of a downtrend, it's at a flat trading. So what's that morning star signal act like? A little mini scoop pattern. Where is the entry on a J-hook? It can be in two places. You can either start buying here, knowing that it's heading back up to test this level, and once it gets up here, one of two things are going to happen. Either it's going to break through, confirming the J-hook, or it fails as a double top. You try to get back out with hopefully a little bit of a profit or at least a break even. So depends on how aggressive you want to be, and depending on what you're trading. If this was a 10-minute chart, and I took my profits up here as it was pulling back, I might be buying right here, knowing that it's heading back up on a J-hook, but I know very quickly if it fails right here, I'm going to close out the position again. So morning star signal at the end of flat trading, and notice where the flat trading was supporting, right smack dab off the 50. Then this acts like a little scoop slingshot effect, starting your next uptrend. So if we know what the signals and patterns are telling us, and we can add the prospect of support based upon a major moving average that everybody else is watching, we can be back into this position well before everybody else starts getting in, knowing that it's confirmed based upon the signal and the support off that moving average. So moving averages, Breaks through, they come back, act as support. Come up, fail, heading back down. Come up through again, pull back, act as support. Or we know what the different patterns are. Here's our T-line crunch. It came up, couldn't close below the T-line, and notice how the T-line kept crunching up back up through the 50-day moving average. Anytime we see this and they start pulling back, and then you can see that they're not closing below the T-line, you get ready to buy back once it comes back up through the moving average. This is what we call the bobble, kind of a derivative of the T-line crunch. It comes up, hits that moving average, sell signals, you start taking profits, but you can see they can't close it below the T-line. Get ready to buy it back the second time it comes up through. The bobble then creates that high probability J-hook pattern. Bobble, T-line crunch. You also have the prospect of seeing where your trend channels are developing. And we have the advantage to see if we can see that a trend channel is developing by drawing parallel lines. We saw that it topped out here, and you could draw a parallel line. Pretty much can draw a parallel line here and anticipate that once it gets back to this level, if we start seeing buy signals, when we shorted up here, we want to start buying again. Next move, back up to the top of the trend channel. And notice the two elements that happen up here. A kind of bearish harami, a good distance away from the T-line, and right at a major resistance level. If it opens lower the next day, it's time to take profits. Where are we heading to now? Back to the T-line. If it fails the T-line, now where are we going? Back here to the bottom of the trend channel. A morning star signal, not only at the bottom of the trend channel, but notice where they bounced off, right off the 200-day moving average. So visually, we can see exactly where the bottom or the bottom of the trend occurs and where the new trend starts. We can see that buy signal right smack dab off a major support level, and the stochastics in the correct condition, and you've got a large morning star signal with a close above the T-line. Makes it very simple analysis. You stay long until you see a sell signal and a close back below the T-line. Whoops, somebody is flinging me. No audio. I'm still here. Somebody was flinging me. All right, so there are times in an uptrend where you might see a potential sell signal, but we've already established that it's staying above the T-line. So a bearish engulfing signal closing below the T-line. What's our next criteria? It has to open positive and trade positive to stay in it. If it opens lower, you close out your position. Why would we give it that extra day? Because it's already told us it's pretty well staying up above the T-line. So let's give it one more day to see if that's confirming. On the other hand, like in crude oil a while back, you're in a downtrend until you see buy signals and a close above the T-line. Where's your next target? The 50. And doesn't matter whether you're trading the daily chart or a 10-minute chart. They all look exactly the same. Oh, Doug, that may be me just hemming and hawing. We also have patterns that we can see coming off moving averages and a major pattern like the fry pan bottom. Notice how our T-line worked very effectively all the way up here until we see a sell signal close below the T-line. Where do you think the next target is going to be? Going back to test the 50. So this creates what we call the classic pattern. A fry pan bottom, and what do we expect coming out of a fry pan bottom? A very strong price move. Then it pulls back. How do you identify a fry pan? It looks like a big fry pan. You couldn't trade this long or short if you wanted to. Then when it becomes most effective, is when you're up here in the overbought condition and they break out of the beginning of that pattern. This is one of the 6 or 7 candlestick patterns that work extremely effectively, kind of just a buildup of energy, and then when it pops, there's usually a very strong price move. And what's our prerequisite for a J-hook pattern? A very strong price move, pulls back, then turns around. And what do we know about a J-hook pattern? We know that wave 1 and wave 3 will approximately be the same magnitude. If we see a move up, we're in the overbought area, and we see a potential reversal signal right smack dab off a resistance level, that's pretty much telling us they failed up here. Jake, there's 12 major signals, 6 buy signals and 6 sell signals. That's what you want to go look. They're on the website, and that's kind of the bread and butter. That's the bricks and mortar of candlestick analysis. There's about 50 or 60 signals in candlestick analysis, but if you just learn the 12 major signals and understand the other information the Japanese rice traders provided on identifying those signals, you pretty well have as good a grasp of what goes in or what makes prices move as somebody that you would see that has been trading for 50 years. Website is www.candlestickforum.com. Yes, if you go to our products and services, we've got 2 sets of flashcards. One is all the signals, and it will show you graphically what they look like, and on the back it will explain how they work. We also have another flashcard box that shows all the patterns, whether it's Western patterns or candlestick Japanese rice trader patterns. And we also have some very high-tech products, like a mouse pad that has all the 12 major signals on it, or a 2-foot by 3-foot poster that every American family should have in their living room showing you the 12 major signals. So when we can see there's been a reversal, especially right at a major resistance level, that pretty much tells us when the downtrend has started. That's exactly what happened a couple weeks ago, 3 weeks ago, when we had all these dojis in the NASDAQ followed by a gap down. That's what started our downtrend. So if we can recognize what the overall market trends are going to be doing, that's right. Everybody should get a poster for their mothers on Mother's Day. Yes, the T-line crunch and the J-hook pattern can be done in a bearish manner also. So if we knew the downtrend was starting, that means we could analyze all the charts. Apple doing an evening star signal right here at the 200, closing below the 200 as well as the T-line. When it gapped down the next day, pretty much told us we were in a downtrend. So if you're short Apple, what should be your criteria? Stay short until you see a candlestick buy signal confirmed, and you'd like to see it close above the T-line, but if you moved a good distance away from below the T-line and see a reversal signal, more than likely that means they're coming back up to test the T-line. Also told us that the airlines were getting soggy. You can see what happened in Alaska Air. Shooting Star, Spinning Top, Hanging Man, Doji, and then a close below the T-line. I told you that it was time to start going short. The fact that they gapped it down through the 50 and this support level told you they wanted to get out of this in a hurry. Same scenario on American Airlines. Where did they fail? Right smack dab at the 200 with a doji followed by a gap down. So again, this is not rocket science. This is just showing where things should be happening based upon the patterns and using the moving averages. This is June gold today. As a matter of fact, right a few minutes ago. You can see what was happening. You had a fry pan bottom setting up. And what do we know about a fry pan bottom? You can stay long as it doesn't close back below the T-line. Right now, you can see this wee little dot. That's where it's trading after hours, is trading up a little bit. So what does this tell us? Well, first of all, we know that the market in general is still pretty soggy going in this direction. But it's probably also indicating that gold stocks, if gold keeps moving up, are probably going to act pretty well. Same scenario on crude oil. You can see what happened with crude oil. There's the T-line crunch, brought it up through the 50. Hold back, where to? Right smack dab to the 50, did a morning star signal. Where do you think the next target was? They did a kind of a bobble right here at the 200. Went up through the 200. That was today's trading. It was trading up just slightly after hours. So there's a good indication that if they trade this positive, this uptrending channel is still going to be in process, which means the gold stocks and the oil stocks that we've been in for the last few weeks, that we started taking profits over the last few days when they started trading below the T-line, now we'll get ready to start buying them back. Do you normally get in on daily chart and exit on 10-minute chart? Or do you mostly day trade or swing trade? I mostly swing trade in my in the big stock accounts, and then I've got some small demonstration accounts where I use those for buying options or showing how to day trade futures. We've got 2 chat rooms. This room usually has maybe 160, 180 people in it every day, talking about mostly stocks and the patterns and the setups. Then we also, so that we're not mixing terminology, we've got another chat room where we've got option traders that are illustrating the best option strategies for certain chart patterns. And then I have Michael Tomset come in for about 2 hours every day, and he goes through charts in fine detail to show the different strategies using options. And then I also put out a couple future trades each day. So today we bought live cattle, and we're starting to buy crude oil again. Does the overall market direction influence your decisions? Yes. Obviously, if you have a portfolio, and again, the way I keep my emotions out of my trading is if I've got a portfolio, and let's say it's a $500,000 portfolio, I will pre-decide that I'm going to have 10 positions, equal dollar amount. Voice is cutting in and out. What time does Michael Tomset present? He usually comes in around 10 o'clock Eastern time. I try to pop in a couple times a day, and then he comes back in around, I want to say 3:15 or so near the close. The website is www.candlestickforum.com. Let's see. And so, Johnny, yes, the market, obviously, if the market is heading up, we want to be predominantly long. Now, that doesn't mean we're going to have 10 long positions on. We might have 8 long positions and 2 short positions. And then as the market is heading up and starts looking a little bit toppy, more than likely we're going to start coming out of some of our long positions and adding short positions, so that when the market does turn and go back down, we're not sitting with long positions that we have to immediately close out and go short. We probably already kind of massaged that in the right direction as the top has kind of filtered itself out. Let's see, who just asked that? Sam? We're going to go to live charts here in a minute. So anyways, this is how, again, whether you're trading futures, currencies, commodities, stocks, trading options, the advantage is greatly enhanced by seeing what the signals and patterns are at those moving averages. Yep. Oh, that's a promo piece. So, all right, let me do this. Hold on for a second. We're going to flip to the live charts. Jim, I'll close this down. Do I? as far as buying the videos, which are obviously at a discount for members. But on top of that, I try once a week to pick a night where we do a special topic that's already in a video so that you can see it live. And so this next Tuesday night, we're going to be doing the most effective entry and exit strategies for trading. And I'll kind of go through some of that as in the live charts here. But let me go through what we normally do, which is usually analyzing which direction is the market heading. Well, as we can see in the Dow, ever since it rolled over and back below the T-line, where do you think our obvious target is going to be with our stochastics getting down close to the oversold area? Probably they're going to come back and test the 50-day moving average. That same scenario on the S&P, and then our NASDAQ, as we saw, with a bunch of dojis up here in the gap down, we're still in a downtrend. Now, I was telling people today, when you're getting out here where there is nothing to look forward to or see as far as a support level, use anything that you know other people are using, because we have, again, the advantage of seeing what's actually going to happen at those levels that everybody else is watching. So if you put your Fibonacci retracement levels on here, all right, now you can look at the 38% retracement here, the 50 here, and the 62 here, just to give you kind of a target. Does that mean that's where it's going? No, what that means is we've got things that we can see that everybody else is watching, that if we see a candlestick reversal signal here at the 38, that's where they're buying. If it drops all the way down here and we see a reversal signal, it's the 50 is where they're buying. So we can use any other technique that we can think of, whether it's a trend channel, moving average, anything that, what am I trying to do here? Oops, I'm trying to remove. Anything that can tell us when to start looking for a reversal and then watch to see what our patterns are. How much do you emphasize, or how much emphasis do you put on stochastics? I know there's a lot of the stuff you show are in the opposite position. You're looking for candlestick buy signals in the oversold area, but you have a lot of chart patterns that usually will be most effective once you're in the overbought condition. Do you confirm the reversal signal in the stochastic indicator? Do you confirm the reversal signal in the stochastic indicator? Oh. Okay, rephrase that. I don't understand. You just started to trade. The current candle trades past the center of the previous candle opposite your direction. You normally close out the trade. No. If it opens positive, let's say I was buying right here. Let's say I was buying right here. It opened positive and then came back down through this level. I don't close it until it closes below the halfway point of that candle. This is a bearish engulfing, yes, but remember, a candlestick buy signal is only effective, or a candlestick reversal signal is only effective if it's in the right condition of the trend, which means a candlestick sell signal in the overbought condition doesn't mean very much. A candlestick buy signal in the overbought condition doesn't mean very much. What we're looking for is a candlestick buy signal in the oversold condition. How do you identify reversal? By the signal. What is a good reversal signal? Today, Nugget did a bullish harami. A bullish harami is where it opens above the previous day's close and closes below the previous day's open, which in Western terminology means an inside day. But in Japanese candlesticks, that's a harami, which basically tells you the selling has stopped. How would you have traded the recent short at the T-line with those little dojis gap? I don't know which one you were referring to, Sam. That's right. As you can see, a candlestick signal is formed based upon where it opens and closes. Those are the I don't know what the other chart was. What did I just do? I can't remember what I just did. So the other movement of the day is just noise. So here's a case where we had kind of a little kicker signal. The next day, notice what it did. It came all the way back down here, but that was the final decision. They closed it up here. The NASDAQ. So what was the question? How would you have traded the recent short at the T-line? First of all, we need to see a candlestick reversal signal. Now, if I'm short, for example, we're still short the airlines, but you started to see some dojis down here. We're in the oversold area. So where would be the logical place that would tell us after seeing a doji in the oversold area to close out this position? Wouldn't want to see it trade back up through the high of this doji day, because if it came up through there, pretty much tells you which way they're going, so you cover your short position. So again, most of the entry and exit strategies is just purely common sense based upon what is the investor sentiment doing, especially after a reversal signal. Can I use this method for 2-minute, 5-minute, 10-minute? Yes. Trading the E-minis. Now I used to trade the E-minis off the 1-minute, 3-minute, 10-minute combination. So remember, if you always keep one facet of candlesticks in the back of your mind, which is the signals are the accumulative knowledge of everybody buying and selling during a particular time frame. Doesn't matter whether that time frame is a 1-minute time frame or a monthly time frame. It's telling you what the overall investor sentiment was during that time frame. Oh, Elaine, I hate when that happens. You look at pulling candle. I mean the leading candle. Okay, you're just kind of confusing me here. I look at where we are in the trend and what type of signal we're looking at. Isn't the trade in 1-3-minute, 1-3-5-minute chart is just like market noise? Again, it all depends on how fast you're trading. If I'm day trading the E-minis, trading off a combination of the 1-minute, 3-minute, 10-minute chart combination, I might be doing 60 trades a day. If I don't want to trade that fast, I might be doing a 5-minute, 10-minute, 30-minute combination. So it all depends on the nature of how fast or slow you want to trade. If I'm swing trading, I'm usually trading off the daily chart, but then I'm making my entry and exit strategies based off the 10-minute chart. Where was the short entry on ALK? Well, we knew that after seeing a bunch of dojis up here, into the overbought area, and was it occurring right at the same level it topped out before, that we could start shorting here because it was starting to trade back below the T-line. What did we need to see on this day? We needed to see it open positive and trade positive to stay long. If it started trading back below the T-line, it was time to go short. If you missed that move, you get ready to short on the gap down, because where did the gap down? Through the 50 and through this support level. That told us after selling, they were ready to get out of this with great enthusiasm. Same scenario over here. This is a little bit easier. American Airlines, a doji followed by a gap down. That was an easy one to go short right in here. If it had shorted and then bounced here and come back up, yeah, you may have covered it. But the fact that you had a doji up near the overbought condition right at the 200 and they gap it down through the support levels, that tells you want to be out of that trade and or going short on that trade. If I see that it's getting very close to the T-line at the end of the day, but it's already confirming a sell signal, yeah, I'll probably close it. Because there's lots of times, and I can't remember some of them right now. Maybe we'll see some of those in the shorts. TZ, that's up to each individual. Now, I know a lot of people in the chat room use if they see a good buy situation, they may also look at the weekly chart to see what that's doing. So if you have a good buy situation on two stocks and one has a good looking weekly reversal and the other one doesn't, obviously they're going to go with a good looking weekly reversal. No, I don't give importance to volume. My volume is already built into my universe. I'm not trading any stocks that trade less than 200,000 shares a day on average. But if I'm down here and there's a big hammer type day and there's huge volume, that's usually an added indication that there's been a change of a lot of ownership, and that reversal signal gets a little bit more credibility that there's been big volume on that day. But a lot of people say, I want to see stock price going up as I want to see volume go up as the stock price goes up. Well, price and volume have absolutely nothing to do with each other. If a stock price is going up and there's nobody willing to sell it, it's still going to go up on small volume. So we're buying price, we're not buying volume. My average swing trade is anywhere from 2 to 10 trading days. No volume when, I don't even know what that word is. Yes, this chart right here could be a 10-minute chart. It could be a daily chart. If I wanted to see what was happening today, I just flipped to my 10-minute chart. That's what today's 10-minute chart looked like. Still in kind of a constant downtrend. Okay, let's take a look at a few that, and we'll go through here why they look good. Notice EPE. I guess they had earnings. There's your best friend signal. That's a doji followed by a gap up. And notice where it gapped up off of, right off the 50-day moving average. And they gapped up kind of out of this wedge formation. This one is probably going to be on our recommended list tomorrow. Any positive trading from here tells us we've got wave 1, wave 2, now going into wave 3. Is there a way to trade stocks in a demo account without doing so costing money? Peter, I think, yeah, most brokerage firms have a way to trade, paper trade. Whoops, what did I do wrong here? ETE, another one that came off the 50, and now notice the type of pattern it's doing. It's a J-hook pattern, and whether they do right smack dab off the T-line, there's your hammer signal, inverted hammer, gap up. Where's your next likely target? This is wave 1. We know at least back up here to the 200. Julian, yes, I kind of, as a rough figure, I figure that every 2 out of 3 trades that I use with candlestick signals and charts are going to work. Now, before candlesticks came along, I was even a stockbroker for 8 years, and I was smarter than everybody else. That meant every time I put on a trade, it was because my superior analytical analysis said it should be going up. And when it didn't go up, it was because people that weren't as smart as I was didn't realize why it should be going up. And it would keep going down, and I'd finally get out at the bottom. Now I know that at least 1 out of every 3 trades isn't going to work. So that gets me alert to the fact that if I'm buying, I'm trying to find a situation. If I'm buying at some point, I know immediately get back out if that chart isn't working the way it should. You have to be in the chat room to get your picks at the end of the day, or do you provide? No, you go to our website each night, go to stock picks, and if I have time, I do it in a 2 or 3 minute video to show why we're picking out, but I put out 2 or 3 stock picks every night. Oh, let's see, hold on. Okay, let's take a look at some of the charts. So there's that fry pan bottom, and it gapped up. What do we want to see coming out of a fry pan bottom? That big gap up. But today it didn't confirm. But that doesn't mean this pattern isn't working. So the fact that they opened it and traded it down, this means there was profit taken from the day before. So very simple. We just put a buy stop at today's open because if it comes back up through there, um, you know, Ralph, hold on to your individual stocks. When I tell Jim to do the double line, everybody can put in a stock pick that we'll analyze. So if it comes back up through today's open, which means it opens here and does another green candle, that's telling me this fry pan bottom is breaking out. We did that same scenario while we recommended Mitch today, or Match Group. Notice the kicker type signal is traded positive. If this opens positive tomorrow, you want to be buying because the kicker signal, again, is one of your strongest signal, MTCH. TCP, another kicker signal. We know what to expect on a big move like this. Usually a 45 degree, which in this case would kind of be inconsistent or consistent with the current trend. So if this opens positive tomorrow, you can be buying, figuring that you're going to have a trend like this. Let's see, Legacy. Legacy did what we call the message, gapped up but failed. But you can see what type of pattern setting up. There's our bobble. So if I was buying this, I'd put a buy stop just above today's open, because if it comes up through there, our J-hook bobble pattern's in progress. So that's kind of part of the analysis of how we show people simple entry and exit strategies. We're not trying to buy at the absolute bottom. We're not trying to sell at the absolute top. We're trying to get that fat, high probability part in between with high probability or high correct trade ratio results, because we're not trying to squeak out every dollar of a trade or every penny of a trade. We're trying to make our trades so they're profitable, and the more profitable trades we can do, the compounding effect will be that much greater. I don't trade Forex because it's much easier for me just to trade the dollar, because I can figure out with much more clarity which way the dollar is moving. There's your big hammer signal. Right now I'd be trading this positive. The British pound, obviously with a bearish engulfing signal, I'd be trading the British pound on a bearish side, anticipating they're going to come back here. That's a lot easier to do than trying to trade two currencies against each other. And I don't want to be sitting at the screen all day trying to get a few pips here and there. I would rather short the British pound and hold it for 4 or 5 days, knowing that it's heading in this direction. Let's see. MB. You can see that kicker signal. It didn't confirm today. So we just put our buy stop right up here. If it comes back up through there, the profit taking's over. Can the kicker signal turn into a bull trap? Probably every time you get into a bull trap on a kicker signal, you're probably going to have 20 very strong price moves. Yeah, I can trade the currencies much easier. For example, there's our evenings or shooting star in the euro. Where's it likely to move back to? The 50? Because you can see the trend channel. So I'd be shorting this, anticipating my target back here. Faro, there was that kicker signal. If it opened positive, you buy immediately. Now what do you have? Wave one. Look at where wave one failed. Now you've got a kicker signal back up through. Remember, the kicker signal is your strongest reversal signal. Means investor sentiment was kicked in the opposite direction. An extremely high probability, high profit trade setup. Dean Foods, there's kind of that fry pan bottom, and where are you right now? Right at the moving average resistance levels, coming out of a fry pan bottom. And notice how the fry pan bottom started up. There's that big morning star signal telling you there's been a reversal. Again, John, hold on to your individual stock. When I tell Jim to do the double line, then type in your stock symbol we'll look at. Massey, Another one that can be bought on positive trading after the big gap up today. Newt. See, this kind of had that little morning star signal at the end. Figure your slingshot effect is going to take you at least up to the 200. Again, wave 1, wave 2. Look for wave 3 to possibly take you all the way up into the $16 range. And PMC, again, this is a perfect type of setup to, can you expect a J hook after a fry pan bottom? Not always, but that's what we call the classic. It's a common occurrence to see a big move out of the fry pan bottom and then a J hook pattern. So here's that classic right here. There's a fry pan bottom. Now there's your J hook. Where would I be buying this right now? I just put a buy stop right here, because if it comes up through here, what do we know about our J hook? That this price move here and this price move here will be about the same, which would correspond with coming up here to the 200-day moving average, also pretty much filling the gap. Positive trading means I want to see the stock not falling out of bed on the open, that it's relatively flat and starting to move positive. But at the same time, I don't want to wake up and see that the pre-market futures are showing the Dow is going to open up down 140 points. That tells me it's not a good buying mode. I want to see that the market is moving in the direction that we think it should be moving, and that the stock price also is kind of moving in the same direction. Wave 3 is going to be equal to wave 1. So you have wave 1, wave 2, wave 3. If wave 3 is equivalent to wave 1, that means we can pretty well target that it's going to the 200-day moving average. And CLR, there's a kicker signal. You can see this has had J-hook patterns, now starting the next J-hook pattern. When you say wave, when you can say wave 2 is done, when you see the next bullish signal. All right, so just as well going short as long, we shorted Rovi, because Rovi had this big belt hold signal. And a belt hold signal is when you have a trading range, they gap it way out of the trading range and bring it back into the trading range. If it opens lower the next day, you want to be shorting it. Right now we're short. Where do you think the logical target is? Right down here at the 200-day moving average. We also recommended going short on Gap. There was that big gap down. Now here's wave 2. Notice what wave 2 did. Started seeing sell signals right here at the T line and broke this resistance level. If this is wave 1, wave 3 should bring you all the way down into about the $15 range. Now, does it get to those targets? Definitely not. But it gives you a target to make it see whether it's worthwhile to be long or short a position. Here's a VRA. This is what we call the blue ice failure. Came down, got below the ice, came up, failed with a bearish harami, broke the support. Where do you think the next target is going to be? The bottom of the pond down here at the 200. So going back to, does it always get there? Definitely not. But it's the target. And it's very easy to see when that downtrend is over, when you see a candlestick buy signal in the oversold area. Look at the failure here at the T line. And then there's your doji sandwich. Remember, a doji sandwich is a big down day, a doji. And remember the simple rule of doji? It's going to move in the direction of how they open it after a doji. And they start taking it down, you can short immediately, because we know it's going to move in this direction, and more than likely this candle right here is going to be the same magnitude as this candle. In this case, got a bigger short out of it. Let's see. What did I just do? That was LXU. So this is what you expect, or should expect, coming out of these slow curves, that we can expect strong downsides. This just basically puts you in a position. There's that doji sandwich. There's another doji sandwich. You just stay short. Now we're down toward the oversold area. What's our next likely target? They're probably going to come down here and test this level, which they're almost to. Yes, if your stochastics are in the oversold area, you kind of watch to see if a candlestick reversal signal is going to be forming fairly soon. So it just kind of acts as alert that that might be the area to start watching. There's that flutter kicker signal. Flutter kicker is a bullish candle. Next day they gap it down and do a doji below the low of the or the open of the previous day. And again, what's our simple rule of a doji? It's going to move in the direction of how they open it. So if they move it this way, if you took out that little flutter, you basically have a kicker signal pushing you to the downside. Again, these are all just very simple visual formations, again, that the Japanese rice traders identified over the last 400 years to show us what usually happens in human nature. HUVS, big bearish engulfing signal, opened right at the 200, closed right at the 50, makes this a very simple entry. If this opens lower tomorrow, you want to be shorting immediately because essentially you've got kind of a double top failing at the 200. Where's your next likely target? They could bring you all the way back down here to test this level. And TLRD, darn. For some reason, some of these charts just don't come up correctly. Guess. There's that slow curve. There's your bearish doji sandwich. There's your long-legged doji that opened lower and took you below the T-line. You want to short this one because if this one breaches this level, now you have wave 1, wave 2, wave 3 could be all the way down in this area. Navistar, bearish doji sandwich. Today, notice what they did. They couldn't support. They came back up, resisted at the 200, and sold off. There's your first target. If it breaches that, you're coming all the way back down to this level. So very simple analysis. If you're short a position that's working, you just stay short until you see a buy signal. SNCR, doji sandwich, would be shorting this one on weakness tomorrow on the basis that somebody asked, well, don't gaps get filled? They do. If there's that wee little teeny gap right here that confirmed our buy signal, a gap might get filled 2 days later, 2 months later, 2 years later. We're not worried about it if we're trading this direction. Now we can kind of establish it as a potential target if we're trading in this direction. Let's see, that one might even be recommended tomorrow on the short side. CF, if this opens lower tomorrow, you've got a bearish flutter kicker to the downside. Stay short. And CLVS, to make this bigger, another little dumpling top. Get ready to short this one on weakness tomorrow. And Skechers, there's your bearish doji sandwich. If this opens lower tomorrow, you can be shorting, especially if they gap it down, because now you'd have an island reversal. That would tell me they're bringing it all the way back down to this level. So again, this is just taking the visual analysis of what happens with human nature time after time, and just the Japanese rice traders put it into graphic depictions for us. Yes, use slow stochastics. Do you actually use profit targets or simply wait for a changing candlestick signal with confirming key line? Yes, if I'm expecting this to be the target, but it gets down here and does a morning star signal, remember the signal is the number one criteria. I'm closing out the position, the short position. Let's see, I've been noticing the doji sandwich. Yes, it's a high probability trade setup. Okay, any other general questions on candlesticks? If not, Jim, go ahead and do the double line. All right, and then 4.3 seconds, do the next double line. All right, we'll start from FMC. You stay long, but you're in the overbought condition. You're a good distance away from the T-line, so you pick a logical spot to tell you the bears are in control. At this point, I wouldn't want to see it trade back below this level right here. That would tell me they're coming back to test the T-line. PRMW. This one you get ready to buy on a positive open tomorrow. Telling you they're breaking out of this little fry pan bottom. CNX. This one has to open positive. Again, it's traded right here on the T-line. It's got to open positive and trade positive to stay in it. If it opens lower, close it out. Fit, if you were short, you stay short. Again, that was on the basis that you had dojis. There's your hanging man. Gap down below the T-line. You should have been out of this trade. The next day you could be going short. Right now I'd stay short with the anticipation of testing this level, then testing this level. Olin needs to open positive and trade positive to stay in it. If it opens lower, you've lost the trajectory, close out the position. PAYC, same scenario. Remember, anytime you see a gap up in the overbought condition, get ready to take profits. And what's our simple rule of the doji? They're going to move it in the direction of how they open it. If they opened it lower, where do you think the first target was going to be? Back here to the T-line. And for a short, yes, you can be going short. There was your evening star signal, right smack dab at the 200. Where's your next target? Probably back to the 50, or you throw your Fibonacci numbers on here. Soybeans, I don't know whether I can bring them. Oh, yes, I can. I'm on this chart. Soybeans, get ready to go short. Now, this is after hours trading. But right now, if I was going to go short, I'd put a sell stop right here today or this evening's low, because it comes down through there. It's kind of confirming the selling. Same scenario, back to the 50, or you put your Fibonacci number retracements on here. Let's see, NQ. Get ready to short this one on weakness, if you can short it. You're getting right close to that $5 level. But you've had a shooting star, a doji, a bearish engulfing signal, doji, shooting star, left-right combo. That's a lot of selling going on. I'd be ready to short this one on weakness. Carnival, you want to short this one on weakness. That's a good-looking short. And Smith & Wesson. You can stay long on this one as long as it stays above the T-line. You had your Morningstar signal. You could actually be buying this one on positive trading with the anticipation your next target is the 50. And then there's this gap up here that they'll eventually fill. UVXY. Slow fry pan bottom. Be a toughie to trade, but you can see it's starting to slowly curve back up. Val, it all depends on what time frame you have. If you have time to sit in front of the computer, yeah, day trading obviously is going to produce a much better result for you. I like to swing trade because I can put on my position and don't have to watch it as closely for hoping that it's going to work in the next 2, 3, 4 days. International paper, you stay short with the anticipation it's probably coming back to test the 50 and the 200. If this is Dow Chemical, you stay short until you see a buy signal. AIM, we recommended going short a few days ago because of the big bearish kicker signal. You stay short until you see a buy signal, especially strong buy signal confirmed. Tazar, not very exciting until they break this downtrending channel. If I was going to buy this, I'd put a buy stop just above today's high, which was at 1913. I'd put a buy stop at 1915, anticipating that it would be breaking out from there, or breaking out of that downtrending channel. Bib, right now you stay short, but if it opened positive and came back up through the 50 tomorrow, I'd probably close it out. But then if it came back down through, I'd reshort it. Somewhat along the same lines as this one, where we covered it because it was showing strength, but then it started selling off. We'd reshort this one again because of that shooting star gap down, and we're not yet in the oversold area. CTSH, oh boy, you're starting to bottom out. You're in the oversold area. If you were short on this one, you cover it on positive trading tomorrow and then see what it does at the 50. Whiting needs to get back up above the T line. So we came out of this one when it closed below the T line, but I'll be ready to buy it right back if it comes back up above the T line. And TRXC, this was a perfect example of where you can start seeing where it was bottoming. Would have covered this one. Well, you couldn't be short this one, but I'd be a buyer of this one if they can close it up above the T line. FMC, we did that one. CAVM, we're staying short on this one. This one would have had us worried because it gapped up today, but notice what it did right after it gapped up. It started trading off. So that told us there was still selling going on, even though it gapped up above the previous day's high, but made it very simple. If it was selling off and then turned around and came back up through that level, we'd close out the short position. But right now, we'd stay short, again, because of that kicker signal to the downside. Freeport, you stay short on this one. Anytime you see those gap downs, especially down through the T-line, you want to stay short until you see the next buy signal. The Qs, nothing here yet. Still trading down. You haven't had a buy signal. Did soybeans, HCG. William, that's all up to each individual, whether you want to trade the ETFs. Couldn't get this one on here. Did I do it right? Yeah. And I'm guessing you want Tesla, Don. Tesla, you stay short ever since the slow curve, bearish doji sandwich. Stay short till you see a buy signal. Let's see. Now this is Hecla. Hecla, you can buy on positive trading. If you closed out here, you get ready to buy on positive trading because you're back up above the T-line. MasterCard, just not a very exciting stock to trade because it's an institutional trader and the percent return isn't all that great. If you like it, you shouldn't be short right now. You can go long if it closes back up above the T-line. Visa, same scenario, not a big prolific mover. But right now, I would stay short until you see a buy signal and a close above the T-line. Blackstone, nothing here. At best, you're short, but even a short kind of giving you the impression that you're going to start support right here at the support level. I wouldn't be a buyer or a seller of this one right now. Blue, another one where you stay short. Got this dumpling top. Just watch that you're here at this support level. Let's make this a little bit deeper. You're in the oversold area. So if I was short, right now I'd have my stop at the previous day's open. Today's open. EPE, yes, this one is probably going to be on our recommended list. There's your best friend, Doji gap up. Probably going into wave 3. PRGN, nothing here yet. Just make sure your volume is good on this one. If I was going to be a buyer, I'd probably want to pay $2 for it, knowing that it was bouncing back up off the T-line area. Amazon was in a 45 degree, but the fact that they closed it now below this level told us the bulls are in control. Probably would have us ready to come out, especially if they open it lower. The only way to stay in Amazon right now is for it to open positive and trade positive and kind of keep a semblance of a 45 degree in progress. American Express, another one that's not very exciting to trade, but with it trading below the T line, I would suspect your next target is back here to the 50. ZM didn't come up. FireEye, all you can do right now is stay short. When it broke this channel, you stay short, but you're getting the oversold area just as safety. You put your buy stop back up above today's open, or at today's open. Google is basing. Right now, if I'd been short, it would have been covered. But I wouldn't be buying until it closes back up above the T line. Twitter, I saw, had hit an all-time low the other day. Right now, all you can do on Twitter is stay short until you see a buy signal and a close above the T line. Baba had a good day. This is what we call your message, where it gaps up and closes lower, but the message was that it gapped up, especially a doji off the 50. You want to be a buyer, especially if it comes back up through today's open. Chesapeake, stay short. Haven't been able to get back up above the T line. Monster, stay short. You can't even short this one. You shouldn't be in it. Yeah, I don't think you can short it with it being below $5. Oops. Can't get the XPX, can get the SPY. Still probably got to support here on the 50. 20-year notes heading back up. You can be a buyer of this one. There's your flutter kicker signal up through the 50. Broken this downward trend channel. Probably should have some more upside. And the gold miners, there's your bullish harami at the top, which means if they open this positive, you can see the trend channel, and you can see they're back up above the T line. So that's why we're kind of watching Nugget, the triple leveraged. If it opens positive, should have another strong move in this upward trend channel. ERX, nothing yet. If you're short, you stay short. UWTI came up a little bit today with crude oil acting a little bit stronger, but nothing yet to get excited about. If I was going to buy this one, I'd probably want to put a buy stop at today's open if it comes up through there. IBM had a good day in a soggy market. It's not a very good trader because of the institutional characteristics. But if IBM gets up through this level, that tells us wave 3 is in progress. And Fizz, there's your big bullish engulfing right off the 50. Just keep in mind, the bigger the signal, the more compelling a reversal. All you can do right now is stay long until you see a sell signal. Netflix, nothing here. Haven't been able to. So here's a case where with that hammer and opening positive, we covered the short positions. But then with it coming back down to the halfway point and then trading lower the next day, re-shorted it. Notice it still hasn't been able to get back up above the T line. And price line, stay short on this one after that big gap down. Slumberger, stay short with the anticipation that if it opens weaker, there's coming back to test the 200. A left-right combo is a doji followed by a bullish engulfing signal, or a doji followed by a bearish engulfing signal. The doji is kind of that little indecisive left jab. The bullish signals that roundhouse. William, it all depends on what somebody's nature is. Obviously, trading commodities is going to be a lot faster. The ETFs, a little bit more safer type trading. Oh, this wasn't what I wanted. Yes, it was. ESRX hasn't been able to get back up above the T line either. If you were short, you stay short until you see it close above the T line. Crude oil, yes, if it came back down through, let's say, this level right here, it tells you this whole trend trajectory has disappeared. But right now, I would suspect with the inverted hammer off the 200 and your doji that if it's trading positive from here, that we're still in this trend channel. Yes, on the open, if I saw a doji followed by, especially a gap up through the T line, yes, I'm usually buying pretty quick. Now, pretty quick may be 30 seconds, maybe 2 minutes. I want to see what the market is doing and what the stock price is doing. So sometimes pretty quick, maybe 2 or 3 minutes after the open. BCEI, another one that can be bought on positive trading. You had your inverted hammer Harami telling you the selling has stopped. Then they opened positive, confirming that signal. If they open positive, they're going to move in the direction how they open after a doji, making your next likely target the 200-day moving average. See, we did Google. CVS, stay long. That's a good-looking chart. We did, let's see, Pandora. Wouldn't be long or short this one. There's no direction to it. And Cisco, there's your best friend signal. There's your confirmation that the buyers are still there. That thing's enough to drive you to drink, isn't it? I'd be a buyer of this one on positive trading. You can see the scoop type pattern. AGI, one of the golds, another one that has to open positive, or if it does open positive, you can be buying it, which means gold prices are continuing up. Microsoft, I don't trade at all because it's just too slow and stodgy. But right now, if you were short, I would start thinking of covering the short because you're starting to see a lot of indecisive trading plus some buying in the oversold area. If it opened positive tomorrow, I'd cover the short. I wouldn't be buying it until it closes above the T line. And Cisco, just stay short. Nothing here to show there's any buying. And Sync, again, this big breakout, you can get ready to buy this one on positive trading tomorrow after the breakout. Jay, you want to use it on volatility. It works on all stocks. But the rationale is if you see a chart that has a very good reversal and can move up 4% over the next 2 weeks, or a chart that can move up 40% over the next 2 weeks, obviously I'm going to take the chart that has a nice buy signal and has the potential of moving up 40%. Remember, doesn't matter what the trading entity, it's what's going on in investor sentiment. So the more volatile the stocks, the better and faster you're going to see whether the results are going to occur. Rig, nothing here yet, but you are stuck on the 50. You stay short if you're short, but if it starts supporting here on the 50, I'd cover it because that tells you you're now in this wedge formation. Another one that it probably wouldn't be long or short. There's just not enough direction to it. I'd be trading something else. And YPF. This one with the little inverted hammer gap up, I'd use today's high as a stop. If it comes up through there, it's breaking this down trending channels. So now you have wave 1, wave 2, going into wave 3. REGN. Flutter kicker potential, which means if this opens positive tomorrow, you can be buying because it's going to move in the direction how they open after the doji, which means if they're opening positive and trading positive, if you took out this little doji, you essentially have a kicker signal. Okay. Good Fay. The XPE. Right now you stay short, especially if it opens below the T-line tomorrow. It's coming back to the 50. You can see, once again, the failure at the 200. BWO, stay short, but you're in the oversold area. So right now, if I was short, I'd stay short, but I'd use the 200 as my stop. It shouldn't trade back up above that level. And HTWR, another one where you can go short. You've had the doji gap down. Another doji. If it opens lower, you've got a doji sandwich in the making, which would take you down through this whole level here, taking you into the wave, going into wave 3. HXB or XHB, another one that you're sitting right on the 50. So if it opened positive, if I was short, I'd start covering it. You can always re-short it if it comes back down through the 50. XLK, stay short, but I would use today's high as my stop. Apple, you just stay short on this one. You're in the oversold area, so I'd put my buy stop at today's open. It shouldn't come back up through there if I was short. Facebook, just sideways. Facebook, to me, is not a real good trader at all. Just it's something more that if you're going to do something with, you hold it long term. You follow theory, sell in May and go away. Greg, I don't follow any theory. The charts are going to tell me what's going on. And last year in May, we made tons of money right through the whole summer. Whoops. ExxonMobil, that's a toughie. It's getting a little bit toppy here. So if it opened lower tomorrow, you close out any long positions. I think we did this one. This one you stay short. Yelp. Another one I wouldn't be long or short. Just not enough direction here. Lab D. Nice fry pan bottom. Where do they usually break out? When they hit a resistance level, you can be buying this one on positive trading down. Okay, getting near the bottom here. Whoops, CRM. How come it's doing that to me? S.CRM. Salesforce, another one that if you're short, you stay short. Just watch to see what it does here at the 50. If it opens lower, you can stay short. AMGN, Doji in the oversold area. I would probably just use positive trading tomorrow to get out of it, which means it needs to open lower and trade lower to stay short. Okay, one more. AOSP. And there is no AOSP. JB, we've already been in the market down. I would suspect they're bringing it back to test the 50. So I wouldn't say big market down. I'd just say we're already in that. Yeah, we've been short for a while. And FedEx, oops. FedEx looks like the first target is obviously the 50-day moving average. AOSL, kicker type signal. I'd be a buyer on positive trading on this one with the anticipation it's going to get back up into the trajectory. Okay, everybody. Again, there's not any real signs of buying in these markets. So I just kind of wait to see where the next buy signal. Stay short until you see a buy signal. All right, everybody. Have a good evening. We'll see you bright and early in the. Oh no, we won't. I'll be traveling tomorrow. So listen to David L. He'll have some good picks for you.